Well, 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 just look what the cat dragged in. Me. I know it's been a while since we last had a video. I don't want to take up your time now by explaining why we've been away for so long, but if you are interested, I will explain in the description box down below so you can read that. But we're back now, and you can expect a lot more to come from us, starting with today's video. When it comes to forecasting the economy and trying to predict a recession, there are so many different indicators and data points that we could look at. I mean, even just looking at the releases in the economic calendar each month can leave you feeling overwhelmed. But a recent study by an economist at the Federal Reserve could provide some insights about what you need to be paying attention to and over what time horizons. The study takes 5 indicators that we can follow and splits them into 3 broad categories. First up are the financial indicators. This would include things like the yield curve, equity prices, exchange rates, and so on. Since these are based on the markets, they're forward-looking and set expectations about the future of the economy. So an example that was given in the study is that central bankers adjust short-term interest rates with fluctuations in economic activity, and hence long-term bond yields, which embed expectations for short-term interest rates, incorporate information on future economic activity. The study picked 2 indicators from this category that it says are strong recession indicators. They were the slope of the yield curve, specifically the difference between 10-year treasuries and the Fed funds rate, and the difference between BAA corporate yields and government bonds, also known as the corporate bond spread. For these 2 indicators, they found the time horizon to be quite short. They could predict a recession within the next year. The second category are leading indicators, and these show how much momentum there is in the economy. This includes confidence surveys, housing data, and durable goods orders. These can be useful because if there's a change in momentum in the economy, like if it begins to slow, that can relate to a change in unemployment. The study only picked 1 indicator from this category, the OECD Composite Lending Indicator for the US, also known as the CLI. It may seem odd to pick just 1 indicator, but this one is an aggregate of many other indicators. And again, this was proven to be a strong indicator of a recession in the short term. Now, the CLI does also include some economic activity measures, but it's not that correlated with other measures that track the business cycle. So that brings us on to the last category, which is the state of the business cycle. This shows where the economy is within that cycle by pointing towards whether or not economic activity is consistent with stable inflation. You're probably already familiar with these 2 indicators as they align with the Fed's dual mandate. They are unemployment of the civilian non-institutional population over the age of 16 and inflation, measured as the year-over-year change in PCE. Now, unlike the previous 2 categories which focus on the short term, these indicators are better at predicting a recession over the medium term, stated as being within the 2nd year. So short term is within a year and medium term is the year after. So now we have 5 indicators that could be used to predict a recession in the short to medium term. We have 3 short-term indicators, the yield curve, corporate bond spreads, and the OECD's CLI, and we have 2 medium-term indicators, unemployment and inflation. So how do these indicators translate into predicting the risk of a recession? Well, a lower probability of a recession is linked with the following points. A steeper yield curve for government bonds, that means there's a bigger gap between the short and long-term yields. A decrease in the corporate bond spread, creating a narrower gap between corporate and government bonds. An increase in the OECD's CLI, showing an increase in momentum. A decrease in inflation, lowering the risk that the central bank will need to raise rates, which will restrict economic growth. And an increase in the unemployment rate, which again lowers the risk of inflation and increases the likelihood of stimulative policy. So in that case, if these points are indicating that there's a lower chance for a recession, if we have the opposite case with each of these points, that's obviously going to increase the likelihood of a recession. As the study says, as indicated by the red circles, the period 1 year before a recession quarter tends to see the following developments. The term spread is low, the CLI leading indicator is falling, inflation is high, and/or the unemployment rate is low. These patterns are discernibly different from those seen outside the period 1 year before a recession, the blue circles. However, the study also showed some key patterns that we need to be aware of. For example, yield curves were better at predicting recessions in the short term when the CLI and unemployment were ignored, but approaches using yield curves often overstate the recession signal without considering other factors. Also, strong momentum, as shown by the CLI, could point to a recession in the medium term. Therefore, it's important to consider all the indicators when predicting the risk of a recession, as only using a subset of them could be misleading. And if you want to understand an easier recession indicator, check out this video up here that we posted on the Duomo channel a little while ago. And if you want to understand more about economic data releases and what they're all showing you, watch this playlist over here.